we have Antonio Zuniga of Oakshore Capital. He's on deck right now. Antonio, I'm going to turn it over to you.
Thanks a lot, Mike. How's the audio at my end?
Your audio is perfect.
Fantastic. Again, hey, thanks for putting this investor series together for us. Delighted to be back here along with my fellow panelists. I think we have a really good group. Thank you for all of you joining us all over the globe. I'm counting just under 300 folks at the moment. Today's panel is entitled Opportunities in Private Credit Funds and Performance During Recession. With us today, I'm joined by investment professionals across credit and related asset classes, alternative asset classes. While we've prepared some questions, we're really hoping this will be a very interactive session to address your specific questions and topics. Jeremy and I we're going to be monitoring the chat and the Q&A as we go through. So please put your questions in at any point. We'll work them in throughout. And also we have some time for final Q&A at the end of our time together. So I guess before passing on to my colleagues to introduce themselves, for those of you that don't know me, let me introduce myself. I'm Antonio Zuniga, as Mike said, with Oakshore Capital. Over the past 20 years, I've been involved across many facets of real estate, private lending, and banking. For the past 5 years, I've been managing director of Oakshore Capital. Oakshore is an investment management firm seeking absolute return strategies in the consumer receivable space. We buy monthly portfolios of fresh charge-off consumer debt direct from the originating lenders, and we use third-party owner-run agencies to capture monthly front-loaded streams of cash flow, which aren't uncorrelated to the majority of your traditional asset classes. Great, you've already switched slides, fantastic. So I guess just to focus on 2 or 3 things here, we like debt that liquidates much faster than 5 to 7 years, which is more typical for the fresh credit card debt that's favored by the largest private and public debt buyers. We like forward flows. So that's buying the monthly purchase of debt from the same originator contractually for 6, 12 or more months. There's 3 real reasons for that. First, it helps us create great diversification in our funds over a relatively short acquisition period, typically be as short as 6 months to provide sufficient diversity. Second, it simultaneously keeps cash drag to a minimum, keeps us fully invested throughout the acquisition phase until we close the fund and turn over 100% monthly distributions. Lastly, I really feel it aligns all the stakeholders, not just the lenders and the agencies, the borrowers as well. We come up with reasonable and payment plans, and the investors, and that I'm including there both ourselves, the general partner, as well as our limited partner investors. Let me stop there for now. I'd like to let each of my colleagues introduce themselves and their firm. First, let's have, I believe Brad Lyons from Stabilis is next.
Hey guys, thank you very much, Antonio. So Brad Lyons, Stabilis Capital Management. We are a New York-based bridge lender, founded in 2010, currently investing our 5th debt fund. So we target opportunities in the senior secured space, mostly commercial real estate, national US. We're active throughout North America, South America, Caribbean. We're active in all sectors, short-term loans, so 12 to 24 months. We're known for quick closings, so 2 to 3 weeks. And the fund itself is unlevered, so very interesting time in the cycle. This clearly being the rainy day. The fund was kind of established to be liquid and active kind of on the rainiest day in an economic cycle and sort of harvesting opportunities that are available at that point. Back to you, Antonio.
Thanks, Brad. I think I'm gonna leave myself unmuted. Next, let's have Mark Fitzpatrick with Glide Capital go. And Mark, I think you need to unmute bottom left-hand corner
Good morning, everyone. Mark Fitzpatrick, partner at Glide Capital. Glide's a unique company in that we partner with allocators to build private credit portfolios. Instead of building another product, we help wealth managers custom build a portfolio for their clients. So the team at Glide Capital has a lot of experience within alternatives and fixed income. We saw a huge opportunity 5 years ago within the private credit space to potentially deliver higher yields and lower volatilities within the fixed income side of the portfolios. And wealth managers were really desperate for this type of product. But there's a lot of stress points in determining how to build a portfolio. A lot of time, a lot of expense, and high barriers to entry. So many wealth managers miss the opportunity to build it as they're busy in other sides of their business. The idea with Glide is that we have a lot of experience within the alternatives world, that we are focused on private credit. We've spoken to over 500 managers. We've got 20 funds that are approved that meet our due diligence. We provide technology to these wealth management firms. We provide structuring to make it easy to invest in and rebalance portfolios and report to over 40 custodians. So today, Glide has over 25 wealth management firms as clients worldwide and over 400 million in assets, and really are partnering with these wealth management firms to build the best possible private credit portfolios for their clients.
All right, thanks, Mark. Chris Innes with Dream America, I believe you're up.
Which is a residential lease-to-own company. So we're working with folks that want to buy a house, but for one reason or another can't get a mortgage today. So we're essentially offering them a bridge financing product, but we're not a lender. We are the owner of the assets. From a pricing standpoint, we're getting a cap rate that's typically 8+%, so a couple hundred basis points better than a traditional SFR. And our total unlevered economics between rent, upfront fee, and resale profits is around 14%. All of our clients have skin in the game. We're collecting earnest money from them upfront, which is equal to about 4 months rent. So versus a traditional landlord, we've got a much bigger cushion in the event that there is a default. We also have a lower maintenance cost in our program than a traditional renter. Our tenants are maintaining their home, which they intend to buy over the course of a 12-month lease, so they're not bothering us with maintenance issues day to day. And then the last thing I would note is that what attracted me to this space is there's limited competition. I can count on one hand the number of other companies that are doing this, which is obviously unique in real estate and unique in finance.
All righty, thanks,
That's it.
Chris. Appreciate that. Next up, we have Richard Palouse with Air Asset Management. There's your slide. Away you go. And Richard, you may need to unmute at the bottom left-hand corner.
Richard is having an audio difficulty. He'll be right on.
Okay.
Testing. Can you?
That's
okay,
perfect.
great.
Fire away.
Apologies. Rich Balutz, Air Asset Management. Air Asset Management is a $300 million longevity asset management firm that's focused in on life settlements. Life settlements is the purchase or sale of a life insurance policy in the secondary market, bought typically from seniors who don't want or don't need the life insurance policy. Life settlements is an asset class that's been around since the 80s, and it's now considered socially responsible.
All right. Fantastic. Well, gentlemen, thank you for those introductions. For our attendees, hopefully this gives you a sense of the breadth across our panel. So I'll remind you to please feel free to submit questions at any time. We'll be checking the chat box periodically. I guess to continue, I want to take a look a little deeper at how each of you with me today is navigating the ongoing realities in your businesses. Start with Chris. I really can't watch the news without seeing businesses and individuals. We're still looking for relief from both their banks and their landlords. On the residential end, can you give us what are you seeing in terms of tenant paying the rent, and what are you expecting for the rest of 2020?
Yeah, that's obviously a huge topic. Like you said, we see it every day in the news. First, I want to stress that the fundamentals of single-family rental housing haven't changed. The SFRs are typically falling into workforce housing, and demand for rentals increases during a recession. So the topic about rent forbearance is really a short-term topic. Then, when we look at the news here, I think everybody knows that April turned out better than expected for many landlords. And then, if you dig into May, as of May 8th, 80% of U.S. renters had paid all or part of their rent. Now, you might look at that and go, oh, wow, so 20% of the people skipped out. But we got to look back to May of 2019 and see that the number was about 82%. So it's really not a big difference year over year, although obviously there are a lot of people under pressure who are having trouble making their rent. As a group, it hasn't been a big drop. So I'm actually cautiously optimistic on residential rents for the balance of 2020, because I think employment is going to come back, and or government assistance, which steps in. I know some of all of our tenants have been able to pay their rent, and I know some of that did that with the assistance of the $1,200 check that they got from the government. The last point I want to mention on rents, less of a topic, but also in the news, is the commercial rents. You've seen, even just today, Starbucks and Chipotle pushing back on their landlords, trying to change the terms. Now, the landlords aren't going to do that in the short term, but what I think you are going to see happen is, as residential leases roll over, the terms aren't going to change. As commercial leases turn over, the big tenants are going to hammer the landlords. And you will start to see this risk of business interruption being shifted from tenants, whether they can make the payments or not, to landlords. And I think that's a new risk that you have to look at, in office, for example, and retail going forward.
Awesome. Thank you, Chris. Rich, can you provide us a brief understanding of the life settlement as an asset class, as an investment, and then how is this asset class doing? How's it being affected by the current realities?
So the life settlements asset class, as I mentioned, it has been around since really the 80s. Institutional players in this asset class provide a significant amount of liquidity in what they call the tertiary market. The primary market's when the person has sold the life insurance policy. Secondary market is when that person decides they no longer want it or need it, and they sell it to an investor. And the tertiary market is when they're traded amongst investors. There's a lot of liquidity in the existing marketplace, actually more liquidity in the tertiary market than in the secondary market currently. The primary driver in life settlements is longevity, which is completely uncorrelated and unaffected by the broader markets. And so when you see 35% movements in the stock market, you're seeing really no discernible effect to the value of a life settlement. So the performance has been steady, uncorrelated, positive returns throughout this event.
Okay, fantastic. Next, Brad, I want to turn to you. In these financial environments, when certain times seems this is when you really shine. How has the opportunity set evolved during the past several months, and how is your firm's investment strategy adapting?
Yeah, sure. Great question. So for us, our fund is, call it $500 million on Fund 5, and we're unlevered. So that kind of means that we don't have the opportunity to manufacture yield on the back end, which means we got to get it on the front end, which makes us expensive. So we tend to price at 10% plus 2 points for our best opportunities. We may price slightly inside of that, but not by much. So as we survey the opportunity landscape when pre-COVID, when times were good, we competed based on speed to close, so 2 to 3 week closing, and then certainty of execution because we were unlevered. Our pricing kind of put us in sort of a rescue capital kind of position. Today, it's completely changed. Today, our pipeline is up probably tenfold The quality of opportunities that we're seeing is just stellar, really from top to bottom of the pipeline, which is unusual. Pricing is less relevant. You effectively have a seat at the table just if you're liquid, because most of the commercial real estate finance market is sitting on the sidelines or dealing with asset management or capital calls, margin calls, et cetera. So for us, the opportunity set is vastly improved, both in terms of deal quality, sponsor quality, just locations. We're getting access to opportunities that, we wouldn't have seen 12 weeks ago.
Excellent. Okay, very good. I guess I'll drop a quick comment. At our end, at Oakshore, we're still monitoring closely any regulatory restrictions affecting ongoing collections. And interestingly enough, the collections have held up much better than anyone initially would have expected back in February or March. It's likely due to we buy quite broad and diverse accounts across many consumer markets in the U.S., but perhaps more importantly, I think it points to these consumer credit facilities are increasingly how most Americans count on to make essential and stable purchases. It's not just discretionary ones. And it potentially also points to a general resilience across the broader market, even during these challenging times. So I guess with that, before we ask our panelists about the opportunities they're seeing ahead of them, let's just check in. Q&A, I think those were prior answered. Okay, on the chat. Question from Bill Beimel to all panelists. Question for the Oakshore guy. How's pricing expectations changing with the anticipation of a longer protracted recovery, including higher unemployment? That's actually a great question, and I'll give you my thoughts, and if anyone else wants to chime in as well. So on a protracted recovery, in the Great Depression, we had 25% unemployment. So I guess the other thing is for every person not working, you still have three out of four people working. So what we typically see is that the pricing from the banks that we're buying from typically falls much deeper and faster than any slowdown on collections. And since we are buying across regions and not all regions go in and out of recession at the same time, we can time the focus of what files get worked on by the agency. So while we don't look for high outlier portfolios to be the bulk of our returns, we typically see a substantially higher returns and a larger percentage of outliering returns during these difficult times, which sometimes is counterintuitive. Does anyone else want to talk about their market with regards to long protracted recoveries? Okay, we can come back to that as well. So
I'll jump on that quickly. Just in
fire away.
Sort of what we're seeing in sort of the commercial real estate space is just color from calls, broker calls, calls with borrowers, calls with others in the industry. Most of the color to us is surprisingly optimistic. It's focused on a V-shaped recovery. As soon as we get a vaccine, this will be dealt with, and we'll be right back to where we were. And you look at public equities, you look at the S&P 500, how equities are trading. You look at the liquidity in the credit markets right now, the corporate credit markets. It's surprisingly liquid. It's surprisingly positive. It's surprisingly optimistic. I think we have I would call it a contrarian view. We think that this is severe. We think it's much more severe, obviously, than the last downturn, and we think it's going to be more painful and much more protracted. And I'm kind of surprised at just how bullish sort of the color is that we're hearing throughout sort of our side of the industry.
Yeah, we have to pause and be respectful. All right, with that, let's focus a little bit on the future areas that you each see as opportunities. And again, if relevant at any point, you can share how you expect your asset class to perform during these challenging times. Let me start with Mark this time. Which private credit strategies do you expect are going to perform well, and which strategies do you think will have more challenge at this time?
Yeah, thanks, Antonio. It's a really good question because, as people know, There's a big difference between the public markets and the private markets. Public markets obviously have a lot of liquidity, which is a great thing, except for in times of uncertainty, and that uncertainty gets priced in very quickly and violently, as opposed to being in the private markets where there's less liquidity. That can actually be your friend in these times because it forces patience. And when we look at the private credit industry, it's over $800 billion. And that sounds like a lot, but it's not as much compared to a lot of the other asset classes within private investing. What we focus on within private credit is trying to find those strategies where there's really strong collateral. There's experienced lenders that have strong balance sheets. I think these are the ones that are going to do well in these times. Cash becomes very, very important. So how you manage your cash becomes incredibly important. And it's important to have not only good collateral, but the ability to take over those assets and operate them if necessary. So those are the types of things that we've been focusing on when looking at this large asset class. We also try and avoid those strategies that are using a lot of leverage, those that are experiencing a lot of inflows and securitizations and other things that could force the hand of liquidity. So I think those that will be challenged will be those that are trying to be liquidity providers that have a mismatch between the assets and the liquidity, that may have inexperienced teams that are chasing yield, that are using leverage, maybe those that are depending on some kind of short-term payback, that it seems everything is going to be a little bit more delayed now as there's more workouts that have to happen. And those that don't have collateral, or those that don't have the ability to operate the collateral. On the flip side of that, there's going to be a lot of opportunities in this type of environment for those that do have the asset management capabilities, the experience, and the cash. We like strategies like life settlements and certain areas within commercial real estate, but it's really all about the team and the ability to go out there and navigate through these challenging times. Those that can operate assets and can take advantage of distress will have really good opportunities in this type of environment.
All right, thank you very much for that. Brad, can you help us identify some of the challenges in your industry over the next 6 months?
Yeah, I think it's a tale of two partners. It's or two platforms, right? It's the platform that was 3-to-1 levered on the back end going into the downturn and is now dealing with hundreds of millions of dollars of margin calls and being illiquid and being known throughout the industry, but just not being in a position to act on what could prove to be once in a lifetime type opportunities, versus a handful of platforms like Stabilis that are unlevered, right? So and just looking over the questions log here, one of the questions is, where are we finding opportunity and how are we structured? So our fund is it's institutional investors, it's cash based, and our fund is unlevered. So we have sole discretion over deployment. So we're drawing from the fund to make senior secured whole loans, call it up to 75% LTV on existing commercial assets with cash flow all over the US, typically with term and credit on the rent roll. And we're doing so at 10% plus 2 points, so 12% IRR. For 12 execution. It's a liquid strategy. It's unlevered, so we're not dealing with margin calls, if collateral value were to go down. But to be perfectly honest, we're sizing the loans to 75%. We think that last dollar exposure is, and it's not an appraised value, that's our value. We're sizing to a last dollar exposure that we believe is bulletproof in the most severe recession, which we think we're obviously coming into that part at some point here. So that's the strategy. We don't. Another question that popped up is, we don't do mezz. We're not a pref equity investor. We're not an LP equity investor. It's always senior secured short-term bridge.
All right. Thanks for that. We have a couple questions popping up in the Q&A. Let me, Chris, let's do your question, and then we'll jump into the audience. Do you see any significant distressed opportunities on the horizon that investors should be capitalizing on?
Yeah, so for the space that we're in single-family housing, just by way of background, the idea for Dream America came from my experience in buying thousands of REO properties in 2010. So I've always got my antenna up looking for distressed opportunities. That being said, Dream America's current focus is on median price single-family homes in markets where if you earn a median income, you can afford that, which is important. Just in terms of underlying value for the house. So I don't see a big distressed opportunity coming yet because the supply is very tight. There's no new construction. We're talking about homes that are in the low 200s, and you just don't see new construction at that price point. The demand, if anything, is rising given lower mortgage rates. And while financing availability for individuals through mortgages has fallen recently, it's maybe back to where it was in 2015. So there's still, for people with decent credit, mortgages are still readily available. So we would have to see less credit availability to individual buyers, a spike in foreclosures, the houses moving to the banks, scenario like we saw in 2008. And also remember, even going back to 2008, where we had a lot of bank failures, the foreclosures didn't peak till 2010. So if you're waiting for a distressed opportunity in this space, I don't know that it's going to come, and if it will, it's still going to be a few years off in the future.
Exactly. That's actually a really great point. Okay, so let me, Scott Roman had a question. Sorry, Adam Petrell had a question for Stabilis. I think it's already been answered regarding Mez. Question from Merrick. Can we get some examples of hard money deals from the last month or two? If Brad, would that be something you could chime in on?
Any examples from the last month or two? Yeah, so we have, okay, so just a series of examples. So typically Stabilis with our pricing is not necessarily competitive in the multifamily space. That sector is obviously dominated by money center banks, regional banks on the construction side, and then the agencies on the permanent financing side at levels that it's just not interesting to us. We've recently been shown a series of opportunities, a brand new Class A multifamily, call it, January 2020, February 2020 type deliveries where you've got 2 to 5 to 7% occupancy. Great assets, great sponsorship, great submarkets. We know they're going to lease. We're generally not a lease up lender, but for something like this, yes, it's going to get there, and it'll lease as soon as the leasing offices open up post-COVID. So for those are opportunities that we wouldn't even have seen, right? And now we've got a seat at the table and have an opportunity to come in and provide 12-month bridge financing. Yes, we're expensive, but we're liquid. We can take out the construction lender. We can bridge to either a conduit type execution, bridge to a bank execution, or bridge to agency execution, which works all day. We've historically not been that active in retail over the past several years. Most of the deals that have kind of come to us over that time period have just, it's the guy who's buying a regional mall at 18 cap, but it's going to 0. So that's not interesting to us. Over the past 12 weeks, we found probably a dozen fortress location retail opportunities with term, with all the right credits, necessity-based retail, and just a ton of confidence in the business plan going forward. So those are just, in 2 different sectors, profiles of deals that we're seeing. We're seeing similar things in the industrial space. So really, across sectors, the opportunity set has just become vastly improved over what it was, 13 weeks ago.
All right.
I'll add a couple of comments there. Mark from
Will
Glide. Mark from Glide.
Yeah, I was just gonna, if I can just, before you chime in, Brad, while Mark is speaking, would you take a crack at 2 online regarding the land loan and land financing? Sorry for the interruption.
Yeah, no. It's a great question. Tons of requests for land financing.
No.
Tons of
Could
requests
you answer that online while
got it right now. Yep, got it.
Perfect. Sorry for the interruption. Go ahead.
No worries. Thanks a lot. So at Glide, we invest into a lot of real estate managers, and what we're seeing is that there continues to be demand for loans, and there's less people that actually have cash to put to work. And so the environment has changed quite a bit in favor of the lenders, where we can now get higher interest rates, lower loan to values, better borrowers, and it's a very good environment for organic type of loans. But there's another opportunity that's looming. That is the fact that for the last couple months, the private markets have been somewhat shut down in the real estate space. The courts have been closed, and everybody has been basically frozen. And we expect that to happen for another few weeks or a month or so. And then all of a sudden, those that were lending that probably shouldn't have been lending to certain properties, those that were using leverage, those that don't have the asset management capabilities, those that are in maybe multi-strategy type funds where real estate's a piece of this, and this is held up well to date, are going to be looking for liquidity. And that's going to create some very good opportunities on the buy for those that have cash over the coming months, and those that have the asset management abilities to underwrite a loan in a challenging environment like this, and to be able to operate that asset if needed. So we should see some good opportunities in the real estate space. We'll talk more about that later.
Excellent. All right, so let me do one last question before we move on to the next section. Question for Rich. You'd mentioned the socially responsible aspect of the life settlements. Would you like to elaborate on that?
Sure. So Air Asset Management is a signatory to the Principles for Responsible Investing, which is a kind of a global SRI organization that has standards set by the UN. But the asset class specifically has become recognized by a lot of socially responsible investors because of its dedication to helping solve senior financial independence. There's a study that was done that 7 times on average of the cash value was paid for life settlement for those seniors. So by the London School of Economics. So if a senior had $20,000 in cash value in their policy and they settled it, they were getting upwards of $140,000, and that's significant capital for a lot of those folks. You've had a really a maturation of regulatory. You now have upwards of 8 states that require some type of notification when a senior is going to lapse a policy, that the insurance company needs to notify that life settlements is an option. So you actually have the regulators, which were 20 years ago a lot more skeptical of the benefits, now telling seniors that or telling insurance companies that they must inform seniors. So that's been a real shift in the space. But senior financial independence is the issue that it supports.
Okay, great. That's actually quite insightful. All right. So with that, I think we actually, Mark, would you mind typing? There's a question for you on LTV, debt service coverage ratio, in the Q&A box. All right. So in this for the next section, let's talk about a little bit about investor structure, the point of view from the investor standpoint. Rich, can you compare and contrast different structures that investors can access to participate to invest in life settlements?
So life settlements, because they're not exchange traded, they're over the counter, like a lot of investments in the private credit space. There's really 2 main structures. There's the hedge fund structure and a private equity structure. So the hedge fund structure typically has quarterly liquidity, and maybe there's some form of lockup. Liquidity is achieved through trading in the tertiary market, as I mentioned earlier. That's robust. The one issue that you're going to have in the secondary market is because you have a mark-to-market component or a mark-to-model component, depending on how sophisticated your valuation is. We're one of the few firms that actually use a mark-to-market style component. You will have some conditional correlation to the liquidity markets. If everybody's selling everything, then you can buy stuff cheaper, and then the IRRs are going to go up, and then your marks are going to go down. So the hedge fund structure, you're going to have in very distressed times some conditional correlation. We have not seen that as of yet. We did see that in 2009 as a function of what happened in 2008, but we haven't seen that yet. The other structure is a private equity structure. That's long-term. Advantages of the private equity structure are you're going to get really the most true non-correlation, because typical private equity structures may not have a mark-to-market. They may have a cost basis, and where you're only really marking realized returns. And again, the driver here is mortality. So you really have one of the most uncorrelated asset classes in investing with life settlements because of the underlying driver of income. And it does work well in both an open-ended and a closed-ended structure. However, you're going to get even more non-correlation with the closed-end structure like most investments.
Oh, excellent. Very good. Appreciate that. Mark, if you're done typing, let me give you a question. What characteristics do you look for in private credit strategies, and what questions should investors be asking before selecting a credit fund?
Sure. So I already highlighted the characteristics that we focus on: experienced team, strong underwriting, strong collateral, deep understanding of the asset, and ability to take it over and operate it if necessary. And we also like life settlements where it doesn't change in an environment like this. So what kind of questions should you ask a fund that you're considering investing into, or a lender of a particular deal that you might be focused on? Number one for us, we like diversification, so we like the funds. So we want to know how diversified the portfolio is. Valuation is very key. That you want to see independent administrators and auditors, but I would not stop there. That you really want to focus on how do they account for defaults and what they're going to do in a default type situation. What's going to cause their loan to become negative in any sort of condition? How much of a buffer is there in between the loan amount and the value of the assets? We want to see the value of the assets be at least 30%, 40% above the amount of the loan, so that there's a large amount of protection there. The other thing you should focus on in valuation is there any independent valuation agents that are actually valuing the loans, like is often done in the life settlement industry, or maybe there's an independent valuation committee. It becomes important in certain times because if there's a problem with one of the loan, you want to make sure that somebody's looking at it and providing an independent assessment whether or not that loan's impaired in any way. Many times it's not because the collateral is really strong. However, you want to see that type of oversight. You want to focus on whether they have that expertise within the asset. You want to know who their borrowers are. Are they experienced? Are they inexperienced? You want to know if their investors are experienced or they're inexperienced. And really, what is the situation if there is a default? What is their collateral? How difficult is it to take over the collateral? Would they want to own the collateral? We like the strategies, like in commercial real estate and groups, where they don't loan against anything that they wouldn't be happy owning if the worst case scenario happens where they have to take over that asset. We're also not looking for those that are trying to lend so that they can take over these assets. So it's trying to find that right balance. And the main thing for us, again, is how hard is it to take over the collateral if necessary? Have you underwritten the situation to an environment like this where you can take over that collateral? And do you have an asset management capability to operate it? We like strategies where we invest into families that have been investing into real estate for 3 generations and can operate the collateral easy. We don't like strategies where there's collateral and you just write off the receivables if somebody doesn't pay, or they really just don't know how to operate the collateral taking it over. So those questions are important.
Okay, very good. That was quite in depth. Chris, is there anything that you want to add in terms of the cities, geography-wise, some of the best opportunities that you're expecting to see?
Yeah, we think there's a lot of interesting opportunities nationwide. Me personally, I love New York City, but I haven't lived there for many years. But from an investment standpoint, we don't like the big cities, which has nothing to do with COVID. Dream America has been focused on the Southeast to capitalize on many things, including affordable housing and the move away from the high-cost, high-tax states, which has already been underway. Demographically, millennials are starting families, as we all know, later than prior generations, but as they do, a move to the suburbs is natural, and that may be, instead of a move to the suburbs of New York or San Francisco, that they pick up and move to a lower-cost, low-tax state like Florida. So we like Atlanta, Jacksonville, Tampa, Nashville, and Memphis. In terms of what we're avoiding, it's areas that are highly dependent on travel and leisure. So we're avoiding Orlando, Las Vegas, and others.
Avoiding those.
We're avoiding those, yeah, just because too much uncertainty right now. I'm sure there'll be some great opportunities long term, but just too much uncertainty right now as to what all of those, what do casinos look like and what does Disney look like reopened.
Excellent. Very good. So I want to pause here. Right now, our Q&A, I think we've hit everything from the attendees. Again, remind you if any questions, either a question for all panelists or any specific one, encourage you to type into there. So I guess in the meantime, I wanted to had a few more industry-specific questions that we can ask. So, Brad, how's your firm's expertise relevant to today's markets? And if you have
Yeah, no, great question. So Stables was founded in 2010 by a former senior executive of Goldman Sachs who ran the Latin American asset-backed trading desk. From 10 to 14, our debt funds almost exclusively invested in commercial real estate distressed debt. So we were a prolific buyer of notes at that time. Obviously worked out those notes. And 2015 is when we made the transition to become a bridge lender. We've continued to buy notes over the past several years. Obviously, nowhere near sort of at the volume that we were doing coming out of last downturn. But the reason I reference that is Stabilis has kind of deep distressed debt expertise. It's kind of in our DNA. Today the opportunities that we're seeing aren't necessarily distressed, and the stuff that's distressed right now or was distressed in 2019. Our opinion of the stuff we saw was it was just broken. It wasn't really distressed. There was no recovery to be had. So really, what we were focused on in the note purchase side of the business is buying like maturity defaults off of regional bank balance sheets, which for us, it's fine to own a maturity default, and your default rate might be 13%. We can buy it at par, and we know it's a good asset, and that's that. There's going to be more opportunities to buy notes here. We also provide note-on-note financing to buyers of notes. So if you think of a real estate GP and owner operator was a beat in an opportunity to go buy a piece of debt, take that asset through foreclosure, and then complete his business plan on the other side. That's something that we're very comfortable financing. So we would provide note-on-note financing to the buyer of that note, finance through the foreclosure, finance the business plan on the other side. I think there's going to be an opportunity to execute on that strategy. It's a little ways off. We also see opportunity right now. We see actionable trades in the fix and flip space, which is something that we're obviously we find to be very, very attractive.
Excellent. Thanks for that. A question for the Q&A tab. for Rich. Can you provide some guidance on anticipated returns going forward in life settlements?
So the life settlement marketplace, it remains active. I mean, you're seeing a little bit of a downtick in the secondary market due to social distancing. That's the market where the advisors are advising the senior to sell their policy and how to sell their policy. The direct-to-consumer markets have been fairly robust and active. We anticipate a lot more opportunities as seniors are going to be looking for more liquidity, we believe, as things start getting back to normal and they're starting to sort through and focus in on their finances. The slide that is up when I'm speaking really shows where returns are generated in life settlements, and I'll just do a quick breakdown of that in terms of where the risk is. The mortality risk adds, and these numbers are rough, right? But just on average, maybe about a 5%, premium to it. That's something that through diversification in the portfolios you put together, you can mitigate a significant amount of that. Because these are liquid investments, that's a couple percent in terms of liquidity risk because they're not, market traded, and there's an over-the-counter, marketplace. The esoteric risks are maybe 3.5%. So the market rate is, depending on how you measure it, kind of in the 12.5% range. You got fairly good credit. So the credit risk component isn't significant at 1.25. And then, obviously if you do a risk-free rate analysis, we know where that's at. That's, minuscule right now at maybe, 70 basis points, 72 basis points. So about 12.5% IRR, you can buy policies, at on average in the marketplace, and we see that continuing.
Excellent. Let's see. Okay, done. Let me save. I have a great question from Adam. Let me save that one. Let me do this one first. Mark, best opportunities within private credit now? It's running together. Have we already touched this?
Not specifically, but a lot of the same things, and maybe I'll give a little.
If you have something to add to it, then great, and then we'll move on to the Q&A.
Yeah, no, definitely. We're seeing a lot of opportunities out there right now in certain segments that obviously this is an environment where you need to play defense first before you play offense. But we're certainly seeing dislocations starting to emerge. First of all, we like strategies. I'll give a little plug to the team over at AIR there, like life settlements, where the asset value doesn't change in an environment like this, and you're not concerned about defaults because the insurance companies are on the other side and they're well capitalized and they're uncorrelated to the equity market. So we have been doing a lot within the life settlement space, and we'll continue to do that. We're building some managed accounts within the space and seeing some dislocations happen in that area and opportunities to buy within the tertiary markets. In real estate as well, for groups like Brad at Stabilis there, that's our biggest asset class that we've been focused on. We see some places where they're certainly going to have distress, like hotels and office and retail, but there'll also be opportunities kind of across the board with those that actually have the cash and the asset management capabilities. There's going to be an opportunity to buy notes at discounts in the secondary markets. And so now you can source similar type properties that you've always invested into at discounts. And those could be 30%, could be 40%. There's opportunities to go to banks and get non-performing loans where they don't have the asset management capabilities within the bank, and that they would prefer to have that happen in the private sector. So we'll see opportunities within real estate, kind of distressed opportunities. Right now, what we're looking for is we like funds that are just starting at the moment that have fresh capital to deploy, or those that have been managing their portfolio where they have new cash to deploy, because the rates are going to be higher and the quality of the loans, there's certainly an opportunity to get better opportunities there. Venture debt, as Jesse mentioned in the pre-Quinn, could be an interesting play as well, because in every crisis, there's new companies that are being created. Those companies need to be funded. Equity can be dilutive, debt can be less expensive for them. And the new companies of tomorrow are often created in these environments like today. So we are patient. We are looking at opportunities though. We think that particularly if you can take longer liquidity, maybe 2 to 4 year type liquidity, then you will do very well in this environment. And we're creating some managed accounts and looking at funds to take advantage of those opportunities.
Excellent. Thank you for that answer. I want to check in with Mike or Jeremy. I have Matt, like 48, 49. We have time for another question or two?
Yeah, Antonio, you can use up till about 12:57.
12:57. Okay, fantastic. Right now, I'll just have one question from Adam Greenvader. I think it's a great question. How would you say this crisis is different than 2008? To tell you my initial thoughts is 2008, you had what really precipitated it was the adjustable rate lending in the residential. It was basically a lender and a buyer created crisis of taking on debt. Today, it seemed, at least from the U.S.'s perspective, I can give you the U.S.'s point of view, what we were doing. It rolled across the country over time. The Midwest was certainly quite badly hit, but it really eventually hit the whole country. But Texas went on for years without any job losses. It was still generating jobs for years. Contrasting that to today, it's really the fluidity of it. We're in a never seen anything quite like this, at least in our modern times, and it's affected everybody equally. It's not like you can go to keep doing business in one region. We're all sort of on hold. As our panel was getting together to prepare for this, one or two of you had some really great insight on that. I'd like to open up the mic to anyone else to differentiate between the two times.
It's Mark at Glide again. Echoing your thoughts and some of the conversation in the last panel, that this crisis, every crisis is different from the last. And this certainly is, as mentioned, that the last one was a little bit more of a man-made crisis in financial engineering and the demand for mortgages and securitizations, and a issue where all of a sudden it was Wall Street versus Main Street. Well, this crisis is very different from that, in that this is a pandemic that we're all experiencing and it's changing all of our lives. And there really is more of a attitude of working together through this. And in our industry in particular, we're seeing that there's going to be more workouts because everything has been delayed, where businesses have been frozen, real estate projects have sometimes been frozen, and we need to create a new business plan. And so we're not concerned from a performance standpoint, but the liquidity has been set back a little bit the loan repayments will not be as robust as originally anticipated. However, at the same time, we're also seeing that the banks are not the problem in this crisis. They're actually providing the liquidity, and we're seeing banks taking out loans and providing that liquidity that just wasn't there in the last crisis. So there, on our side, there seems to be a lot more stability. Will there still be areas where there's concerns and people getting in trouble? There always is, but that also creates a lot of new opportunities.
Yeah, this is Chris. Let me offer a quick one, and that's investor expectations. In 2008, people didn't view it as a great time to invest, or not a lot of people who'd been around in 90 or 91. Now, everybody's been conditioned that a financial crisis is a great time to invest once you can figure out what the backside of it is.
So that brings up a really interesting point about what's the term for when everybody gives up, and that's the part where we're sitting on the sidelines. In that, one, there's the uncertainty of how this pandemic is going to pan out, but also there is a lot of pain and I don't want to be disrespectful to how this is affecting people's lives, both their health, emotional health of being cooped up, as well as financial health. But it just seems like it's still too early, not to throw out the coin about catching a falling knife.
I think
so.
I think 36 million plus new unemployment filings. Like, I think that kind of tells you all you need to know about just how bad this is going to be.
There's more. Yeah, there's more to come. Absolutely. Anybody else on this? I have a question from Andrea Lou's asking, does analysis change regarding buying loans on properties on land leases? If someone wants to talk about that quite specific, I'd also like to, we can kind of modify this and make this slightly more open. How is our analysis changing in terms of our hurdle rates and what we're looking for? At our end, we're putting a little bit more emphasis on new forward flow contracts. We want more buffers. We want slightly more assurances in case things tighten up, and there is both on the buying side and the selling side kind of a wait and see attitude. Anyone else as far as their analysis changing? And if anyone wants to, Brad, you're probably the closest one to talk about properties on land leases. I think if it's similar to your answer on land, probably takes care of it. On Pablo, yes, we can.
I want to step in here. You guys are out of time, so if you can wrap it
Okay.
up.
All right. So yes, we'll get slides out to people. We need to jump on. I think we covered some great topics. If to anyone in attendance, if you want to follow up with any of our panelists, please reach out to